welcome to Macros with Mythili, the ET-Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at the outlook for lending rates in the light of the changes effected by the RBI's latest bi-monthly monetary policy announcement. The 125 basis point cut in the repo rate from January 2015 till the latest cut of 25 basis points has resulted only in a 60 to 70 basis point cut in the bank's lending rate. Will the new measures announced by the RBI, the cut in the repo rate accompanied by changes in its liquidity management framework, get transmitted better to banks? Will it improve monetary transmission? Will it lead to a complete pass-through? If not, why not? We're going to try and unravel the mysteries of a somewhat esoteric subject, monetary transmission, for our viewers with a panel of experts. Pradeep Kumar, former Managing Director, State Bank of India, Venkatesh, Head Treasury, IDBI Bank, and Jayesh Mehta, MD and Country Treasurer, Global Markets Group, Bank of America. Welcome to the show, each one of you. Let me start by putting things in perspective. What determines the lending rates of banks in India? I know there are a host of factors: the cost of funds, essentially of deposits, interest rates on risk-free sovereign bonds, liquidity in the system, RBI's repo, reverse repo rates, statutory preemptions like SLR, CR, the level of NPAs, directed lending. All these play a part. But if you were to identify the single biggest determinant of bank lending rates, what would it be? Is it the rate of interest on retail deposit? And is that what sets Indian banks apart from banks in the West, where it is the dependence on wholesale deposits that matters much more? Pradeep?
Yeah. See, if you see the NCLR formula itself, one of the biggest components in that formula is the cost of borrowing for the bank. In an Indian bank scenario, cost of borrowing is effectively cost of deposits, because borrowings constitute a very small portion of the bank's liability side. Maybe 2 to 5%, maybe 2 to 3% for public sector, slightly more for the private sector. So effectively, I think the cost of deposits is the biggest component which goes into the computation either of the base rate or the new MCLR formula. My view is that cost of deposit will have a weight of 60 to 65% in the formulation of the base rate or the MCLR.
Okay. So would you agree with Pradeep's assessment, Venkatesh? 60 to 65 of the cost of lending is dependent on the cost of deposits?
Yeah, I agree. I agree in the sense that the major component when you compute whether it's the base rate or whether it's the marginal cost of lending rate, I think the major thing is coming from the cost of borrowing, and out of that borrowing it is the deposit which plays a major part in the funding source. So I think I fully agree with what Mr. Pradeep has been talking. It plays a very important role.
And Jayesh, would you go along with both of them, or would you have a different perspective?
I think I would have a different perspective. So I have one, of course, liquidity now that's taken care of. Let's see how it gets passed. Second is, on a more macro basis, why base rate and MCLR? It's a question of how comfortable you are able to lend it. So, if you look at it previously, the people used to lend to, say, people like IOC and others with hardly more markup over GSEC. So I think that's going to be a key determinant. But yes, now we are into base rate and we moved out to MCLR, which is better than base rate. But from a private and foreign bank perspective, and people who have almost CASA of 30 to 40% plus, I think one more component on the borrowing side is interbank borrowing or the repo borrowing, which also ramps up the cost.
Okay, so we'll come to that issue later, Jayesh, because I know foreign banks and private sector banks, especially the smaller ones, have a different perspective. But Pradeep, that leads me to my next question. If it is the cost of deposits that, according to you, and Venkatesh agreed with you, that is the main factor in determining lending rates, must lending rates necessarily be sticky as long as deposit rates are fixed and lending rates are mostly floating? And is the stickiness asymmetric, with banks being happier to pass on rate hikes but less willing to pass on lower rates?
I think your statement that banks are not willing to pass on decreases in rate and willing to pass on rate increases is not fair. I think if you see history, rate cuts have come with a lag compared to the repo rate changes, because I believe the repo rate change is a signal to the banking system to start reducing its deposit rates. And because of the nature of the deposit rate being fixed, it is quite sticky, and therefore it takes time to bring down the cost of funds. Of course, in this new formula for MCLR, RBI expects the banks to estimate its cost of funds based on the new rate for the entire corpus of deposits, which I think is not very fair, but that is the system that is going to be. I think the very nature of the fact that deposits are fixed and the loan rates are floating, some amount of asymmetry and some amount of time lag will always be there in the transmission.
Venkatesh, Pradeep said that it's not that banks are reluctant to pass on rate, lowering of rates any more than they are willing to pass on rate hikes. But how are banks going to cope with the fact that when interest rates are going down, the MCLR is going to be increasingly lower than the weighted average cost of deposits? Will banks have to keep a cushion to take care of this? And what will happen when rates start moving up? Will there then be a clamour for banks to revert to weighted average rates? Also, if I remember right, both SBI and IDBI had tried using floating rate term deposits in the past, and both had to give it up as a lost cause. Can you tell us why these experiments failed, and what do you think the outcome will be in the new scenario?
I do agree in the sense that we were one of the pioneers in issuing floating rate bonds as well as floating rate deposits along with SBI. So I would always say that there is not that sort of a desire by the depositor or the investor to come into a floating rate bond or a floating rate deposits. In the past, yes, lendings have happened based on MIBOR, which Jayesh has been alluding to. But what I'm trying to say is overall, when you look at the lending, essentially the deposit is fixed and the asset is floating. So to that much extent, there is a huge interest rate risk maybe the banking system is taking. So you need to do something to the derivative market, interest rate derivative markets, whereby maybe as professionals, maybe as the financial advisors that the banks are, that the banks should be able to maybe manage that interest rate risk by actually using a derivative instrument to manage that. So that is where I think this MCLR is finally going to lead to, in the sense that initially MCLR they are trying to say that the whole outstanding liabilities is supposed to be restated with the current deposit rates, which is your card rate, and the deposit has not been sourced at that rate at all. But still you take that and then try to work out the MCLR based on whatever is overnight, the 1 month, the 3 months, 6 months and 1 year sort of tenor premiums, and then put it out. So I would say that over a period of time now, the bankers will, especially the public sector bankers, will have to use the derivatives to make their liabilities also floating. So to that much extent, the liabilities gets floated and the asset also gets floating. So to that much extent, the interest rate risk will get minimized. So if we are able to do that successfully, I would again say that whether it is falling interest rate regime or higher interest rate regime, the banks will be much protected. So to that much extent, the ALM desk of the bank has to manage it properly.
Okay, Jayesh, Venkatesh said it is possible using interest rate derivatives to have some kind of protection. But is the situation very different for a bank like yours, which has a limited branch network? And you alluded to this earlier in your first answer. What to your mind are the main factors that facilitate really efficient transmission of the RBI signals? And has the RBI's liquidity framework obstructed transmission in the past? It has now promised to move away from its liquidity deficit is good mindset to a more neutral stance, of course, without specifying any time frame. But will that suffice? After all, the RBI supplies relatively limited amounts through its OMO and LAF operations, and the bank's ability to use these windows is also limited by their holding of securities. In fact, if I compare the RBI's interventions in the money market with its interventions in the forex market, it seems that the RBI's ability to guide exchange rates is much greater than its ability to influence interest rates, at least when it comes to preventing excessive rupee appreciation. I know that calls for a long answer, so I promise not to interrupt. So please go ahead, Jayesh.
No, I think there are a couple of things, right? So first and foremost, we are all talking about this transmission very recently in last maybe year or so when we started cutting rate from Jan 2015, and then we are talking about transmission not happening. And the two things which have changed according to me, it's broadly number one, when we introduced base rate, say way back in 2009-10, that became the base parameter. I'm not going into the calculation of base rate, but that kind of moved away your blue chip corporates, large ones, away from borrowing in locally, and they went to offshore markets. And that's then the banks started going more so into project and infra financing, because that was kind of matching their base rate. So that's one part of the story. Second part of the story, if you really look at it, ultimately it is the liquidity. Now, whether it's bond market, whether it's lending, everything. I think last 3 years we have seen liquidity being negative. Even if you look at just before that, because of spectrum, it's almost like, I don't exactly remember, maybe 2011, 10, 11 onwards, right? We were into deficit, but not so large deficit, but we were into liquidity deficit situation. So when you have a liquidity deficit situation and the set of banks scrambling for the same amount of money, either through deposits and whatever, so your cost of borrowing is going to go up, and there is no question about, you are able to relay that back to the system. So even when you cut rate last year, liquidity not being there, that was the showstopper. And somehow I feel, we are all directly, attacking transmission and in lending rates, but if you really look at it, even on the bond side, the transmission didn't happen, right? If at 125 basis point, okay, bond market do, as said by a lot of people, bond market do anticipate, and therefore it is pre-priced. But let's be very honest, quarter end 2014, did anyone expect more than 75 basis point? I thought I was the most optimist on 75 basis point for 2015. I think the market consensus was quarter to 50 basis point, and we got 125 basis point rate cut. So nothing was built into the price of bonds. And unless your transmission happens to government bonds, transmission to lending rates or anything else becomes a little bit difficult. So, just to put it in a much simpler way, unless your Sensex moves, or your mid caps is not going to, it's going to be very much anomaly only if your mid cap moves and the Sensex does not move. So I think that's where we have to look at. First, the benchmark needs to move. If the benchmark moves, the rest will all follow.
Absolutely. In fact, you made a very relevant point, because surprisingly the benchmark has moved not so much in response to monetary signals from the RBI, but following the presentation of the budget, when the government stuck to its fiscal deficit target and small saving rates also came down. So it would seem as if the bond market transmission itself is very poor. But I'm afraid on that note, it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we are discussing the outlook for lending rates following the changes announced by the Reserve Bank of India in its latest bi-monthly monetary policy with a panel of experts, Jayesh, Mehta, Pradeep Kumar and NS Venkatesh. Pradeep, the RBI has promised to meet whatever it says it calls are the requirements of durable liquidity. But in the light of the past experience with RBI's assessment of what it calls durable liquidity, once again will it fall short? Because even when its target was a deficit of 1% of NDTL, net demand and time liabilities, the deficit was actually much higher and on a sustained basis. Could the reason for this tendency to err on the side of a deficit rather than a surplus be a consequence of its inflation targeting approach that the RBI has now adopted?
I think RBI is always afraid of injecting more liquidity into the system than is necessary. They are always afraid of inflationary pressures. But right now there is so much excess capacity in the system, I don't think any operations like the OMO infusing liquidity is going to be inflationary at all. And this durable liquidity which they want to introduce, which is 1% of the deficit, if they are going to take a long time to do that also, I don't think it is going to help the banks. If they take another year for introducing that 1%, then I don't think it's going to help the system at all. If they have to do it, they have to do some dramatic changes immediately. Of course, yesterday I'm told they did about 15,000 crores, but they'll have to do it in a much quicker than the 91 year or 2 year target they are having for improving the durable liquidity. See, unless the banks are confident there is enough liquidity in the system, they will hesitate to cut deposit rates. And if they hesitate to cut deposit rate, consequently MCLR or base rate also will not get reduced immediately. So if there is banks get assurance of sufficient liquidity in the system, I think, and with the government also reducing the small savings rate, banks will be willing to cut the deposit rates. And if deposit rates get cut in the current scenario, the MCLR gets changed immediately with the review happening every month. So if the RBI is really serious about transmission, they must give enough signals to the market that there is enough liquidity in the market.
So basically, Pradeep, what you're saying is that banks need to be assured that they will get liquidity, and that is what they're not certain of in the present scenario. But Venkatesh, if the RBI's view is that there is a need for durable liquidity, wouldn't a reduction in the cash reserve ratio, the CRR, have been the more obvious step? I know the governor has argued against a CRR cut on the ground that it's already quite low at 4% and close to what the Narsimham committee had recommended as a desired level of about 3%. But the Narsimham committee recommendation was made almost 25 years ago. So should we still be so reluctant to cut the CRR? So my question to you is, are you really convinced about the RBI's reasons why it has not cut CRR and prefers to do this OMO, which is never very satisfactory as far as the banks are concerned? Venkatesh?
Yeah, I agree. Most of the banks have always asked for the CRR cut to happen. But if you are looking at the seasonal pattern of the liquidity that comes into the system, you will always find that essentially from April to June, there will be a lot of liquidity coming into the system, mainly from the fact that the government balances which are there will get drawn down because they will start spending and those money will start coming in. So I would say that RBI was right at this particular point of time not to look at the CRR as a tool to actually cut and provide liquidity. But at the same time, using the OMO to provide liquidity, maybe what they are trying to say is, okay, let me expand my domestic balance sheet, so that is where I think they are buying back the securities and pushing the liquidity, which gives a little bit of a durable liquidity. At this time, I would always say that from April to June, not much credit offtake, nothing, not much economic activity happening in the system. I think liquidity was not an issue. It was essentially, I would say, their stance on liquidity was an issue. I think they have changed that stance considerably. That is, they were always looking at keeping the liquidity in a deficit mode. Now they have put out a roadmap and said that yes, we are moving it from deficit mode to a neutral mode. So that itself will give a sort of a expectation from the markets that as and when the market needs money, the Reserve Bank is there to maybe push in liquidity either through expansion of their own domestic balance sheets or maybe cutting the CRR and giving that sort of liquidity. So I think at this particular point of time, the more emphasis on the new framework of liquidity, narrowing the spread between, let us say, MSF and reverse repo, I think these are all things which are warranted, which I think Reserve Bank has done it well. Which will ensure that going ahead maybe the transmission should also happen, because for transmission to happen I do agree that you need liquidity. That is, if you are cutting rates, you need to provide liquidity for the transmission to happen faster, and when you are tightening rates, the liquidity should be kept in deficit mode. Now we are on the downward spiral, so I think liquidity is required. Hopefully I think Reserve Bank will start looking at the CRR maybe going towards the October policy.
Jayesh, Venkatesh made a very subtle difference between the liquidity per se and the liquidity stance of the Reserve Bank of India. And he says that actually liquidity was not such a problem, it's a seasonal issue. But my understanding, and correct me if I am wrong, is that liquidity was in deficit for a much longer time. It was not a seasonal phenomenon, number one. And number two, does the stance in itself make a difference? In fact, the RBI's argument that it kept liquidity in the deficit mode was that it wanted to ensure the pass-through of its signal in a rate hiking cycle. So by that logic, will it now keep liquidity in surplus now that we are in the liquidity reduction cycle? And there are a number of other measures also it's announced. So which of these measures do you think will really enable liquidity to come into that surplus mode? And will the RBI be comfortable with liquidity in surplus given that its eye is always on inflation?
I think firstly we are all moved, suddenly we got good news, so we are all moving to a slightly different stance than what RBI said, right? It's RBI said near neutral does not mean we are going to surplus mode. So I think that's one fundamental change I would put it. But more importantly, as Venkatesh said, seasonality, yes, it is there. April, May particularly, seasonally, government spending comes in and it comes back into the system. But if the stance would not have changed, and at least we got to see one, and as also Pradeep said, that one is stance changing, but we need to see walk the talk. I do believe that they will walk the talk, but there are a lot of people who would like to see the walk. They already seen the talk, so that's a little subtle difference there. But April, May, if the liquidity stance would not have changed, this time we were so short of liquidity, and even typically in a accommodative stance, April, May, we will go into a surplus mode. This year, the way the liquidity was, it would have, unless, and even now, even if we don't get a couple of more OMOs, I don't care whether it's OMO or injection through buying dollars, whatever way, as long as the injection happens. If there is not couple of more happening, we still may not go in April, May into surplus mode, because we had such a large deficit of liquidity. So typically our estimate is like, government spending would be, assuming nothing would have happened yesterday, the government spending would have been around 80-90,000 crores. We would have been still short of almost 70,000 crores if nothing would have changed. At least of that 70, we got 15 coming in tomorrow, and let's see how it goes, how it pans further. And I think that's what market is looking at, is that action being followed up, and how fast and how quickly.
Okay, so you are waiting for action to be followed up after the talk. You want the RBI to walk the talk. But Jayesh, if I can ask you once
No, I'm not waiting. I believe in them. I think the market is waiting for that.
Okay, but Jayesh, if I can ask you, what is the time frame within which you expect this liquidity to ease sufficiently as to bring lending rates down substantially? And which of the measures do you think will have an immediate impact? The shift to MCLR, the narrowing of the corridor, the CRR calculation, which of these do you think will really have an impact immediately?
No, of course, see, a CRR cut has immediate transmission, right? That's an immediate thing, because it's a chunky thing which comes at one go, right? I think that's where, but then it's like, you have 0.5% CRR cut, straight away 45,000, 50,000 comes in, which is as good as 3 OMOs, or like, buying out almost like $8-9 billion, provided that $8-9 billion comes into the country. So CRR is a very, very effective dose. Which is immediate transmission happens. But having said that, we are in that conducive mode at this month, particularly since we are in April, May. They don't need to do more. Maybe even if they do a couple of more OMOs by May, or whatever equivalent purchases of dollars, the infusion, and we will go to almost neutral situation. And I think if there is action being followed up, I think people will start believing walk the talk. And once that confidence is there, so it's, I think next 2 months is crucial in terms of overall how we go to neutrality is something, of course, in between we'll go to neutrality if the talk is followed in next 2-3 subsequent OMOs in next 2 months. But later on, how we go about it, as Governor was explaining post policy, he looks at 20,000 crores, 20 to 30,000 crores for the new built up, and the existing 1% of NDTL, which is say maybe 80,000 crores or so, 10,000 crores there every month. So the existing shortfall of 80 will be spread over 8 months. That's what I understood from his analyst call yesterday. And but whatever the incremental will be given back to the system if it is durable. So which would be around 20,000 crores, which would be given back.
So clearly a lot depends on the efficiency of the monetary transmission mechanism. But Pradeep, will the shift to MCLR, which is a very important component of that better transmission, will it be net positive for the system if you do a cost-benefit analysis? What to your mind are the benefits and what are the costs? Because ultimately, if you want to go through with MCLR really and show a decline in lending rates, your deposit rates must also come down, and that could impact deposit growth of banks, which is already pretty low. So net, will MCLR be positive or negative for the system?
MCLR on the face of it looks like negative for the banks, but the advantage there is, of course, they have said it will be applicable only for new accounts that are being renewed, or fresh advances that are being granted, instead of in the base rate regime where a change in base rate was being passed on to every borrower. So this is only for the new accounts, the new renewals, the fresh loans given. To that extent, the MCLR is applicable to only a limited set of borrowers. It is different from the earlier guideline, when the initial draft guidelines, when they said MCLR will be applicable to be everyone. To that extent, banks are protected that the changes in the monthly changes in the MCLR is passed on only to the new borrowers. The formula itself, I think, is unfair to the banks, repricing your entire liability base at the current cost. It is like telling a grocer, like, I have 10 kgs of rice, I buy 100 kgs of rice, I sell 110 kgs at the new price. For the grocer it's okay, because the previous stock is only 10%, the new stock is 90%. For the bank, the old stock is 95%, the new stock is 5%. and I have to sell everything at 5%. That is the anomaly. I think the RBI, I strongly believe this is unfair to the banks. This will have some stress on the bank's profitability.
Okay, so it's unfair to the banks, but Venkatesh, let you have a quick last word. Should the RBI get into the business at all of how banks should fix their lending rates? As long as there is transparency, shouldn't competition take care of ensuring that the consumer gets a good deal and the lending rates are well fixed?
I partially agree on that, in the sense that you leave it to the competition, you leave it to the markets to determine what is the rate which each bank charges to its customer. But then I think we are not in that sort of a market at this particular point of time. So definitely a little bit of regulatory intervention is required for fixing rates, which they had started off with BPLR, then came to base rate, and now it has come to the MCLR. I think the MCLR is really a good sort of rates which will come out into the market. Yes, there will be some pain for the banks, but that will be only a transitory. The reason behind that is most of the liabilities of the banks are, I would say, the duration has come down to 1 year. So to that much extent, over a 1 year period, most of the liabilities should get repriced. So in this first year of transition, there could be a little bit of a pain. But overall, for the system as a whole, I would say that this is a good thing that you are moving at least the asset pricing based on a floating rate liability pricing, though it is actually not floating rate because you are raising the money in fixed component. But I would say that this is a move towards making the liability also floating over a period of time. So I would say that this is in the public good. I would always say that whatever RBI has moved ahead with the MCLR is a welcome sign.
Well, I do hope you're right, and you called it intervention. Some might call it interference. But I'm afraid we've really run out of time completely, so I'll have to end this discussion right here. Thank you so much, Pradeep, Venkatesh and Jayesh, for joining me in this very lively discussion. For now, the jury will have to be out. Clearly, monetary transmission should improve, provided the RBI walks the talk and does not chicken out of its promise of providing adequate liquidity at the first sign of an uptick in inflation. Thank you also so much for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.